Today, we are diving into a book that Warren Buffett himself has called by far the best book on investing ever written. That's right, we're talking about Benjamin Graham's The Intelligent Investor. Our mission? To boil down its timeless wisdom into a philosophy that actually works, especially in the crazy markets we see today. Let's get right into it. So let me ask you a question. What's the real difference between walking onto the floor of the New York Stock Exchange and walking into a casino in Vegas? For way too many people, that line is super blurry. I mean, they're both places you can put down some money hoping to walk away with more, right? But as we're about to find out, one of those mindsets is an absolute recipe for disaster. You see, that whole distinction between the trading floor and the casino floor, it all comes down to this one really fundamental question you have to ask yourself. Are you investing or are you just gambling? Because according to Graham, those two things are not even in the same universe. Do you remember the dot-com bubble back in the late 90s? It was nuts. The public was basically being told to treat the stock market like this giant, non-stop video game. And this TV commercial from Ameritrade just perfectly captured that feeling. A couple of mouse clicks and bam, instant riches. No real thought needed. It was the absolute peak of what some people started calling the speculation nation. Okay, so this is where Graham draws a really hard line in the sand. He says an investment is when you're essentially buying a piece of a business. You're focused on its real-world operations, you do your homework, and you're just aiming for a safe, satisfactory return. Speculation, it's the complete opposite. It's just a bet on where a stock's price is headed. You're not analyzing a business, you're just guessing which way the ticker symbol is going to go. So once you've made that choice to be an investor, not a speculator, you've honestly won half the battle. But here's the kicker. Your biggest challenge isn't going to be some Wall Street shark or a sudden market crash. No, it's something much, much closer to home. Just take a second and really think about that. What is the single biggest threat to your long-term financial success? Where do those really catastrophic portfolio-wrecking losses actually come from? And there it is. Graham just lays it out there, plain and simple. You are your own worst enemy. It's our emotions, our greed when things are shooting up, and our gut-wrenching fear when they're falling that are the biggest drivers of terrible financial decisions. Getting a handle on those impulses, that's the real key to winning this game. Now, to help us wrap our heads around this, Graham came up with one of the most brilliant allegories in all of finance, Mr. Market. So imagine you own a small piece of a business, and every single day, your business partner, this guy, Mr. Market, shows up, and he offers to either buy you out or sell you his share. The only problem? Mr. Market is a complete manic depressive. Some days, he's totally euphoric. He sees nothing but blue skies and a glorious future. And he'll offer you a ridiculously high price for your shares. Take early 2000, for example. He was so giddy about the internet that he was willing to pay 250 times annual sales for the tech company Inktomi. I mean, that's just an absolutely insane a price. But then, on other days, Mr. Market is just inconsolably pessimistic. He sees nothing but doom and gloom, and he'll offer to sell you his shares at a price that's basically a giveaway. So just 30 months after that euphoric high, he was so depressed about that same company, Inktomi, that he would only pay a tiny fraction of its sales for the entire business. But here's the secret weapon. You don't have to play his game. You can completely ignore his daily quotes. The intelligent investor doesn't let Mr. Market's mood swings jerk them around. They actually use them. You sell to him when he's ecstatic and euphoric, and you buy from him when he's terrified and despondent. Okay, so if you're going to be buying when Mr. Market is in a full-blown panic, how do you know you're actually getting a good deal? You need a core principle, a guiding light, and this brings us to what is maybe Graham's single most important concept of all. He called it the margin of safety. And look, it's not some complicated formula you need a PhD to understand. It's a simple, incredibly powerful idea. Always leave yourself a buffer. The whole secret to sound investing is figuring out what a business is really worth, and then, this is the important part, insisting on buying it for a lot less than that value. Think of it like this. If you do all your homework and figure out a business is worth about $1 per share, you don't pay $1 for it. Nope. You wait for Mr. Market to have one of his bad days, and you buy it for, say, 60 cents. That 40-cent gap, that is your margin of safety. It's your cushion against bad luck, against your own mistakes, and against the crazy swings of the market itself. All right, so let's put all the pieces together. How do these principles, choosing to be an investor, mastering your own emotions, and always demanding a margin of safety, how do they actually help you profit from everyone else's foolishness in the market?
Let's go back in time to March of 2000. Cisco Systems, the high-flying tech darling, was the most valuable company on the planet, trading at a mind-boggling 219 times its earnings. Speculators couldn't get enough of it. Now, on the other hand, you had Cisco Corporation, a, let's face it, boring food distributor, trading at a totally reasonable 29 times earnings. Well, over the next 2 years, the market's folly became painfully clear. The expensive, obvious winner, Cisco, collapsed, losing 75% of its value. And the boring, fairly priced company, it thrived, gaining 56%.
And this really brings us to the ultimate point of all this. The goal of investing isn't about bragging rights. It is not about the thrill of trying to beat the market. That's the speculator's game. For an intelligent investor, the real goal is so much simpler and honestly so much more important. It's making sure your investments actually allow you to meet your own life goals. I love this quote from a retiree down in Florida. It just says it all. Someone asked him if he'd beaten the market over his lifetime, and his response was just perfect. He said he didn't know, and more importantly, he didn't care. His investments had done their job. They got him to where he wanted to be. That right there is the only benchmark that really matters. So, as we wrap up here, the final question really is for you. Take a hard look at your own approach to the market. Is it designed for the short-term thrill of the ride, or for the long-term certainty of the destination? The intelligent investor always knows the answer.